Hey Bowtie Nation, Joseph Hogue here, and stock market volatility is back. After nearly a year without a correction, we've had 3 big sell-offs since February, and 2 just in the past 2 months. 2022 looks like it could be a dangerous one for investors. In fact, Morgan Stanley has set a 2022 target for the S&P 500 of just 4,400. That's more than 5% lower than where the market is right now. That could mean negative returns on the stocks for the entire year. It's one of the reasons why I love dividend investing, because even if stock prices fall, that dividend payment will always be a positive return. In this video, I'll help you create a dividend stocks portfolio that will guarantee you have returns to book in 2022 no matter what prices do. We'll create the dividend stocks list with the highest paying stock in each sector, giving you a diversified portfolio safe from a market crash. Stick around because I'll also show you how to find more dividend stocks and how to analyze dividend paying companies so you only invest in the very best. You know we can't get started though without that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now we're going to get started with the highest paying tech stocks, but I want to explain why I'm picking a dividend stock from each sector. Why not just invest in the highest paying dividend stocks, period? And the reason is to create a list of dividend stocks that's going to protect your portfolio from a crash in any single sector. With this dividend portfolio, I want to give you a diversified list of stocks that are going to pay your bills regardless of which sector of the economy outperforms next year. So let's get into that list, and I'll show you the stock screener I used and how to find these in a minute. First though, the highest paying dividend stock in the tech sector, International Business Machines, ticker IBM, with its 5.1% dividend yield. Now I'm going to take you through some of the fundamentals, some of the things I look for in dividend stocks here, just to make sure that this is the kind of stock that you want in your portfolio. That 5.1% dividend yield is very strong, the highest in the tech sector, but we want to check the payout ratio as well. And for those of you that don't know, the payout ratio is the percentage of its net income. So the percentage of profits the company is paying out to cover that dividend. And this is very important. Here we see it's 126%. So we would want to check that. But what that means is it is paying out the dividend, more dividends than it is making in profits. So obviously that's not something that's sustainable. We would have to see earnings increase at IBM to be able to just to sustain that dividend. So this is a warning sign for a dividend cut. Anytime a company is paying out a higher payout ratio, higher than 100%. So we would want to check that out and double check. But generally, IBM can cover its dividends. What we would want to do is go to we go to this historical data tab, change this time period to 5 years, and then to show dividends, and we can see the dividend history of this stock. And what we want to look for is not only does this has a high dividend yield, but it's increasing that dividend payment. Okay, it's got a good trend, good momentum in that dividend payment, and we can see that it just increased the dividend payment to $1.64 per share here in November of 2021. And it's got a good history of increasing that dividend all the way from $1.33 in per share in 2017. So even though that payout ratio is high, it is over 100%, I would not worry about the dividend, right here, especially since they just increased their dividend. The board of directors, the company, would not have increased that dividend if they were not confident that they could pay that dividend in the future. So that's just something you want to check out with the payout ratio and the dividend growth history. We'll also look at some of the valuation measures here. So we'll look at price to sales, 1.5 times on a price to sales basis. That is in value territory. In fact, I usually like to see that under 1 times. But 1.5 times on a price to sales basis is not bad. It's not too expensive. We would also want to look at some of these other things that we talk about here on the channel. This operating margin, for all you out there in the Bowtie Nation, this is my single favorite ratio, this operating margin. This is the core profitability of the company and how effective management is at turning those sales into operating profits. So 12% here. And what we would want to do is check this against other large tech companies, in IBM's industry, just to see how well it's doing, making sure that we're investing in truly the best management out there. So 12% operating margin is actually pretty good for a mature company in its industry. We can also look at some other things here. The balance sheet. Now, obviously, IBM is a very strong cash flow company. Has operating cash flow of $16 billion a year. So I'm not really worried about the debt here. It does have $8 billion in cash on the balance sheet against $59 billion in debt that it owes. So a huge debt, huge debt owed on this company. But I'm not worried about that because it is making so much cash every single year that it's going to be able to service that debt and not have a problem. And we can go up here and just kind of check out the what analysts are estimating for the stock. We can look at this 1-year target estimate. So now Yahoo Finance surveys the analysts covering the stock, averages out their target estimates, and here you get a $145 per share target price for International Business Machines for IBM, trading right now at about $130 per share. So that's not a huge upside as far as price. 145 divided by 130 is about a 11.5% upside to the target price. But remember, that's still on top of the 5.1% dividend yield. Okay, you've got a stock with a strong dividend growth history, strong dividend yield right now, and a potential 11.5% return just on that average target estimate. So a very good stock in the tech sector for dividends here. Next here, the highest dividend yield in the communication services sector is a stock I recently invested $14,000 in it for 400 shares. AT&T, ticker T, for its 8.7% dividend yield. And now all you out there in the nation, you know I have not always been a fan of AT&T. In fact, a couple of years ago, I did a dividend cuts video warning people that this dividend, the dividend for the stock could be cut, was in danger of being cut. I didn't like the acquisition strategy it was using, some of the companies it was buying, and I warned investors against it. Of course, we can zoom out here on the stock price and see what it's done over the past few years. That was a 2018 video. The shares were at about $32 around that time and have since fallen to $24. But this stock is now in deep value territory. It's paying a very strong dividend. They have warned that it could cut that dividend or bring that down a little bit, but 8.5% current dividend, even if they cut it by half, that's still a 4.25% dividend yield, as well as some very strong upside price potential, I think, in these shares. So we'll go through and look at some of these. Again, 8.5% dividend yield right now. Now it may be cut, that might be cut. We don't know when, but still 8.5% while before it's cut, and then it's still going to be a high. I bet it's still going to be at least 5% dividend yield even after they cut it. We can look at the statistics and look at the payout ratio here. Now the payout ratio, okay, 1,600%. That is obviously not correct. So what we would want to do is go through and actually double check this. And this is something you have to do a lot of times on some of this data just to make sure that they're measuring it right. So you can go here to the financials, the financial statements. You can go to the cash flow statement, and this is going to show you how much the company is paying out in dividends. So if you look at financing cash flow, that's got the dividends in there. And then so cash flow from financing activities, there's net issuance of stock, net common stock, preferred, cash dividends paid. Okay, so the company paid out in the last year, it has paid out $15 billion in dividends. So it's paid out $15 billion in dividends. We can come here to the income statement and look at what the earnings were. Okay, because remember that payout ratio is the dividends paid divided by net income. Okay, how much is that dividend relative to the profits of the company? How much of profits is going to pay that dividend to meet that dividend commitment? So we had $15 billion, and we do see that that net income to common shareholders, that's your earnings, that's your profit for the company. That was just under $1 billion over the last year. So they are paying out $16 billion, or was that $15 billion in dividends against $1 billion in that. So $15 billion. Yep. So we did have 15 billion dollars in dividends paid out, over $1 billion in earnings is 15 times. So that is extremely high. That is obviously, why they're talking about a dividend cut and to protect that cash flow. So I would not be surprised at all if we did get a dividend cut in AT&T, But at this point, you see the stock chart, you see how much the stock price has fallen. It is building in that possibility, that probability of a dividend cut. So I think even once we do get a dividend cut, you're not going to see the stock price fall that much because it's really already priced into that. We can look at the dividend growth history and what it's done. So we can look at 5 years of dividend history here and see that they've kept the dividend at 52 cents a share since the beginning of 2020. Okay, so really, keeping that dividend where it was to protect cash flow over this pandemic years, really that uncertainty during the pandemic. But before that, we did have fairly good dividend growth history, fairly stable dividend growth history from 2017 of 49 cents per share each quarter and up to 52 cents now. So in the past, a strong dividend growth. It's probably going to cut a little bit just to protect cash flow over the next couple of years till it gets back on its feet. But I think after that, after a year or so, it should get back into that dividend growth. Now, what I'm looking at here is really the valuation of this company. Price to sales of 0.95 times. Okay, so it is trading for less than the annual sales the company is booking. It's got very strong fundamentals, operating margin of 18.6%. Okay, so management is doing what it needs to do to convert those sales into operating profits. Revenue growth was weak. Revenue growth was negative 5% on a year-over-year basis in the last quarter, so I would want to check that. I can go here to financials, and I can look at the total revenue. So the income statement and the total revenue, we can see it was $160 billion in 2017, and that has actually risen fairly stably, $160 billion in 2017, all the way up to $181 billion in 2019. It did take a big hit last year during the pandemic to $171 billion, but has since rebounded. It's since $173.5 billion over the last 12 months. So it is seeing that increase in sales. And what I really like about AT&T, where I think it can really improve on these numbers and really surprise the market is if you look at some of these fundamentals, at these financial statements, you'll see a big reason why their earnings were so low over this last year is because it paid out so much money to acquire that bandwidth for 5G. Those auctions, that bandwidth license for 5G auctions was extremely expensive on these telecom companies. So it had artificially low earnings because it had to pay out all that expense, right? Well, that's not going to happen. That's not going to happen going forward. It's already bought those auction prices. It's already bought those bandwidths and those licenses. And, so it's not going to have the capital expenditures and the expense going forward. It's going to have the revenue from 5G as that builds. So I think you start seeing the 5G, the revenue from 5G, the sales for AT&T start heading higher. You start seeing those expenses, those annual expenses come down, and you're going to start seeing better profitability and earnings on this company. And if you look at the 1 year target estimate, just $30 on this share. So, and maybe analysts haven't caught on to that idea. $30 divided by 24, that is still a 25% upside potential on the shares right now. But I think this one goes even higher as we start seeing those earnings improve, as 5G builds and they don't have those expenses. So again, a dividend cut is possible, is probable, but I think this is still going to be a good 5% dividend yield at least, as well as upside price potential. We're just getting started on our dividends list, but I want to show you how I found these stocks. And here I'll be using the screener on Morningstar, but you can do this on any investing app. First, I'm going to filter for only companies above $1 billion market cap. Now that's the size of the company. It's not a hard, fast rule, but I want to filter out those smaller penny stocks, just leaving the dividend-paying companies with the size to survive whatever 2022 brings. Next, I'm also going to filter only for domestic companies, and this is one you can play around with, but I'm just focusing here on US-based companies for this list. Finally here, we'll go to the stock sector criteria and start with the first one here, only those companies in basic materials. Now you can see that leaves us with 79 companies in this sector, and if we sort this by the dividend yield column, we see the highest paying is Southern Copper Corporation with a 5.4% dividend, And we can always double check that number by clicking through to the stock page. And you can play around with these filters here, and later I'll show you how to narrow your dividend list, but the focus here is going to be in finding those highest yielding stocks in each sector for that diversified portfolio. Back to our list though, and the top dividend stock in real estate is Two Harbors Investment, ticker TWO, with an 11.4% dividend yield. Now, Two Harbors is a mortgage REIT, an M REIT, which means it borrows on short-term rates. It borrows money on short-term rates, levers that up 4 and 5%, and then buys mortgage investments at those longer-term rates. So what you're going to see with a lot of these is it is very sensitive to interest rates and can get hurt during it with interest rates. You'll see here this chart of the year. It has suffered this year as those interest rates on the short term, on the short term part of the yield curve have gone up. Because what happens is if interest rates on the short end of the curve, those month to month interest rates, the 2-year, the 3-year interest rates, if those go up more than those long-term rates, then its borrowing cost is going up, but it's the money it makes on those longer-term loans that it buys, that it invests in, are not going up quite as much. Okay, so profitability has come down for these, but this is still a very good long-term stock, 11.4% dividend yield, and you'll see that in a lot of these statistics. It is a very strong cash flow company. It's a little bit smaller at just $2.08 billion, but very strong operating margin, 77% operating margin. And again, you want to compare that against other M REITs, against other companies within its sector, within its industry. Operating cash flow of $633 million, so it is very strong positive operating cash flow. So I wouldn't worry too much about debt and some of these other statistics. Now the payout ratio for this, if we can find, so payout ratio is just 57%. So that obviously it has much more room to increase that before it starts getting into trouble, before we start seeing more of that income going to the dividend yield. So that 11.4% dividend is safe. We can check the dividend history here and change this to 5 years. Look at the dividends only. So we can see that it has increased its dividend just recently, just December of last year, to 17 cents a share. That's paid on a quarterly basis. It did decrease back in 2019. So, it decreased in April of 2020 during the pandemic. The management did decrease the dividend to protect cash flow, but here it looks like it's going on the way back up. And here we can check out the 1-year target estimate, a $6.54 average target from analysts. So if we take that divided by the 596, it's only 9.7% upside potential to that average target analyst, or that average target estimate. Not a huge upside return, but again, with a lot of these very high yield dividend stocks, that's what you're going to see. You're not going to see a ton of price appreciation in the stock because they're paying out so much in dividend yield. These REITs, these real estate investment trusts, they pay out 90% of their income in that dividend. So they're not holding a whole lot back for growth. That's why you only see this 10% upside potential to that average target estimate, but you still get that 11.4% dividend yield. In the materials sector is the copper miner, a theme I think could really take off on growth in electric vehicles. And here is Southern Copper Corporation, ticker SCCO, with its 6.75% dividend yield. Now, as a copper miner, it's got a lot of its assets in Mexico and Chile. Not the most stable jurisdictions, but you're going to see that for a lot of miners, especially copper miners. It's mostly in Latin America and that kind of thing. What I really like about copper miners, though, and all of these minerals and metals that are going into electric vehicles, we could see a supply deficit. I did a video on this just a couple of weeks ago. We could see a supply deficit in copper over the next couple of years because there is 3 times more copper used in electric vehicles than there is used in the traditional combustion engine vehicles. Okay, so we're going to see a huge demand spike in copper demand just for these electric vehicles being produced over the next few years, and that's gonna increase copper prices and could make these copper miners just take off. We can look at some of the statistics here. Yield of 6.8% almost, so very strong yield among copper miners. We can look at the payout ratio. So how much is it paying? It's only paying 66%, of its income to satisfy that dividend. So again, what you want to do with a lot of these is you want to compare them against others in their industry. So I would want to go to other miner stocks, compare that payout ratio, see what they're doing. Somebody paying a very low payout ratio, 66%, it's holding 34% of its net income back for growth. So it could be growing the company it could be growing that stock price, or it just could be leaving room to increase that dividend. What we would want to do here is check the dividend growth rate to see really that its commitment to that dividend and to the dividend growth. So we can change that to 5 years, apply. And look, so it's recently, just in November of 2021, just last month, it has increased the dividend to $1 per share, right? And that is paid out on a quarterly basis. And you can see this has really increased the dividend. I mean, if you go back to 5 years, it was only paying out an 8 cents per share dividend. And it has grown that to $1 per share. So huge dividend growth in this stock. It's still only paying out 66% of its net income, of its earnings, to satisfy that dividend. So there is a lot more dividend growth on the way for this stock, and as well as those higher copper prices and the sales growth in this company. We can take a look at some of the other valuation metrics, only trading at 4.5 times on a price to sales basis. So a little bit higher than I usually like to see, trailing PE of almost 15 times on a price to earnings basis. Again, we would want to check that against other miners and other stocks. A 53.8% operating margin, though. That is superb. That is excellent to be able to produce operating profits of 53% of revenue. So management is doing a very good job here, turning those sales into operating profits and into net income. We can see here quarterly revenue growth. In the last quarter, it booked 25.9%, so almost 26% revenue growth on a year-over-year basis, and that is a lot of that higher copper prices, because we're seeing that demand already come through for those electric vehicles. We're seeing that demand growth, and we're seeing those higher copper prices. So revenue for these copper miners is taking off, and I think that only improves over the next several years. We can take a look here at the year target price estimate. Now here, $61.87 per share is the average analyst target estimate. That is only a couple of percent over the $59 per share target or stock price right now. So, either analysts don't think that this stock is going up much more, or they just haven't caught on to the idea that copper prices are going to stay higher for longer, and this company is going to just keep on increasing that dividend. I think it's going to do the latter there. I think it's going to keep on increasing that dividend. I think the environment is very good for these copper companies, and I think this 1 year target estimate, this target price for the shares, should be much higher than that $62 per share. We've got 7 more dividend stocks left, but first, I want to personally invite you to get the weekly bow tie, our free weekly newsletter with all the stock market news, trends, and strategies you need to know about. It's absolutely free, just something I like to do for everyone out there in the community. So look for that sign up link in the video description below. Next on our dividend stocks list is kind of a different one. In the industrial sector, we have Icahn Enterprises, ticker IEP, for a 16% dividend yield. And Icahn Enterprises, obviously the brainchild of Carl Icahn, doing a lot of that buyout and acquisitions, but it also does run its own businesses, especially in the energy space. So it's kind of that conglomerate energy company. We can check out the yield, 16% dividend yield, which I think that's probably going to be fairly volatile. I think this company is paying out a lot of its income, a lot of its earnings from quarter to quarter. So it's not holding much back for growth, and it's probably going to be decreasing and increasing the dividend as those earnings come in. And we can check that out. We can check that out with the historical data here to see what kind of earnings growth or dividends growth we've seen. Dividends, and then apply. So you can see it's actually held a $2 per share dividend since 2019. So that is a very positive sign that it didn't have to decrease that dividend during the pandemic. It felt confident enough in its cash flow, and we can see that it has increased the dividend. Actually, it's increased it from $1.50 a share on a quarterly basis there in 2017, increased it up to $2. And the fact that it has not increased the dividend since March of 2019 tells me that there could be a dividend increase coming in the future. It's gone almost 3 years, 2 years without a dividend increase. In the past, it increased it much more frequently and increased it each year. So that dividend is 16% dividend yield, very high already, but could actually be boosted here in the near future. We can look at the statistics here and look at the payout ratio. So the payout ratio is actually quite high. So maybe we're not getting that dividend increase. We would want to look at the financials here, look to see what is happening with the earnings and with the sales. So we do see that it has come down. Sales have come down from 19 billion in 2017, all the way down to 7 billion last year, but it has rebounded from the pandemic from last year from $7.4 billion up to almost $10 billion over the last 12 months. Over the last year, it has come up to 10 billion. So it is rebounding there. I would want to check to see why it came down so much from 19 billion in 2017 down to 10 billion in 2019. Probably a lot of divestitures. I imagine they were probably selling a lot of those businesses. I mean, Icon isn't generally known for managing businesses on a long-term basis. He's going to want to raid those companies, turn them around, and then sell them off again. So a lot of times these sales are going to be inconsistent. But if you look here at the net income available to common stockholders, so this is the earnings, and this is where you see that problem. This is where you see the the earnings problem. It's paying out so much in dividends. It probably does have a very good cash reserve to cover the dividends right now, but I would want to be making sure that this net income or this net income available to common stockholders does start to go up, so it can cover that dividend. And if we look here at the balance sheet, just for proof of that, it's got $2 billion in cash on the balance sheet. So that is obviously going to give it some stability there. It's going to be able to cover that dividend for quite some time before it has to either cut or do something about that. If we go up here to the target estimate, now we do see that analysts don't have a target estimate for this stock just yet, or Yahoo Finance is not surveying any analysts that have a target estimate. But $50 per share, 16% dividend yield is one you want to watch. Our top dividend stock in utilities is going to be PPL Corporation, ticker PPL, and it's 5.6% dividend yield. Now, utilities are always very high dividend payers and actually very strong, stable cash flow companies. And with PPL, you get a little bit more diversity, a little bit more geographic diversification than you get with other utilities. PPL actually does have business in the United Kingdom. It has regulated utilities there in the UK, as well as in Kentucky and the eastern side of the US. So you get a little bit more diversification as far as geography than you do with most utilities, which only operate maybe here in the United States or in one region of the United States. It does have a 5.6% dividend yield, which is higher than most utility stocks. We can check the payout ratio to see how much of its income it's paying out. Now, this says it's paying out 146% of the income to cover that dividend. So again, that's something we would want to check. Anything paying out more than 100% of its income to cover that dividend, obviously something that cannot be sustained for a long time. So now if we do look at this income statement, the financials, look at the income statement, and we come down here, the net income to common shareholders, we can see that over the past year, it has produced a negative $1.3 billion in earnings, in net income. So that is definitely a warning sign. That is definitely something we would want to look into. Why is it reporting negative earnings, especially as this sales number, as this top line is actually looking pretty strong? It was $7.5 billion in 2017, went up to $7.7 billion before the pandemic. Came down just very slightly to 7.6 billion in 2020, and then over the last 12 months, it rebounded up to 7.8 billion. So sales are there. It has increased its sales at that top line, but what I think we'll see here probably is cost of revenue did jump quite a bit. Cost of revenue is up to 3.4 billion. And then the operating expenses is quite a bit higher, 1.6 billion, versus 1.3 billion in 2017. So costs have gone up quite a bit. It hasn't been able to pass those costs onto customers, and that has resulted in that lower operating income. We would want to look at some of these others. Net non-operating income. So this is what's really been hurting them here, is this interest expense. So the interest expense on the debt has increased to $1.3 billion. That's what's hurting them. That's what's keeping this earnings down. So we would want to look at the balance sheet. We would want to look at how much debt the company has and if it is cash flowing well enough to be able to pay off that debt. So we can look at the statistics here. We can come down here. Now, normally we wouldn't be too worried about debt for a utilities company because it has a monopoly in that regulated market. The local jurisdictions, the regions where it operates, they set the prices. They tell them, okay, how much profit you can make, and it is basically a monopoly in that area. So they're strong cash flow companies. You can see here that the company has produced $2.5 billion in operating cash flow over the last year. That is core operational cash flow, and that is extremely strong, enough to pay this $11.2 billion. It's got $4.7 billion in cash. So I'm not quite so concerned about the debt. The interest on that debt is getting a little high and is turning into those negative earnings, but I think it can turn that around with that operating cash flow. If we go here to see just what analysts are looking at, again, like we saw with that last stock, only a $31.23 average target estimate on a $29 stock. So maybe about a 3% return expectation on that stock on top of the 5.6% dividend yield. But for utility companies, these are going to be your safety stocks, your stocks that you go to when maybe when the rest of the market is looking a little wobbly. You're still going to get that 5.6% dividend yield. You're going to get some upside price appreciation, and I think you're going to do well with PPL. I'm highlighting one of my favorite sectors next, but I want to open this up and get your feedback. Tech and growth stocks have worked really well over the past 2 years, like ridiculously well. With the 2022 stock market looking a little wobbly, though, I'm shifting to those dividend stocks for those safer returns. But what do you think? Will growth continue to outperform, or will it be value and those dividend stocks for the win? So scroll down and let me know in the comments, dividend versus growth in 2022. Healthcare is one of my favorite sectors for the next few years, and we have here Healthcare Services Group, ticker HCSG, with its 5.1% dividend yield. Now, healthcare services, a lot of these hospitals, these healthcare facilities have really taken a hit on the pandemic. They've been in crisis mode, just serving their COVID patients, and have had to pull back on a lot of these elective surgeries, these elective procedures that are actually higher profit margin procedures. So profitability margins have come down for these facilities, and that's hit this healthcare services group because they provide a lot of the environmental services for these hospitals. They provide janitors, they provide cleaning and supplies, other services that go into to help these hospitals operate. So obviously, if a hospital is seeing its profitability come down, it's going to pull back a little bit on those services. It's going to try try lowering what it's paying for those services and maybe lower the amount of services it uses. So obviously a tough environment for these kinds of healthcare facility stocks. But again, once we get back to some sense of normal, once we get back to just that trend in higher healthcare services demand, aging demographic, more people are getting older, more people are going to be using hospitals and using healthcare services. I think there's a lot of revenue growth left in these companies. 5.1% dividend yield, one of the highest among stocks, definitely the highest in that healthcare sector. And we can look here at the payout ratio to see how much it's paying. Payout ratio is just 87%, so it is in that safe zone, under 100% within its net income. We can look here at the dividend growth. Go here to change 5 years and the dividends. Okay, and so we do see that it just increased the dividend to 21 cents a share. That's on a quarterly basis, paid out 4 times a year, 21 cents a share in November. And if you scroll down here, you can see it's been fairly consistent, actually. In fact, increasing its dividend almost every quarter. So I see it's increased its dividend every quarter over the last 5 years. From 2017, it was paying 18.6 cents per share every 4 quarters, all the way to 21 cents. So not increasing it a lot, but increasing it regularly every single quarter. That's a great sign, a great commitment to their dividend. We can look at some of these other, price to sales of just 0.76% or 0.76 times on a price to sales basis. So definitely within that value stock territory as well. This balance sheet looks very strong to me. It's got $205 million in cash reserves on the balance sheet, and just $18 million in debt. So $180 million in net cash on the balance sheet, covering it for as long as the pandemic lasts, and its revenue growth maybe not quite as strong as we'd like to see. So just $205 million in cash against just $18 million in debt. Revenue growth has been slow, is negative over the last year, and we can take a look at that. We can go here to the financials, look at this income statement, and it has come down. It came down from $1.8 billion in 2017 up to $2 billion in 2018, back down to $1.8 billion. So it was a little bit weaker there even before the pandemic. Got hit further in the pandemic, $1.7 billion last year, and has fallen further as that pandemic keeps on going, and as those facilities really have to pull back on the services that they pay for. $1.6 billion over the last 12 months in revenue. But we do see that it is still producing positive earnings, positive net income. So that's always a good sign that it is still net income positive. It's a 5.1% operating margin, 15% return on equity. So management's doing a great job of turning those sales, even though that revenue, those sales are decreasing. Management is still doing a great job of turning that into operating profits and net income for investors. We can go back up here and check out the price target from analysts. And analysts here have an average price target of $23 per share. That's $6 over the current price. So that's going to be a fairly strong. Here we go. 6 divided by 17. That's a 35% upside price potential to that average target from analysts. In the energy space, the top paying dividend stock, USA Compression Partners, ticker USAC, and a 14.1% dividend yield. Now, USAC is actually in one of the parts of the energy market that has been a little weaker over the past year, even despite those surging energy prices, up to $72 a barrel for oil prices recently. Despite that, a lot of companies are pulling back on that, on that capital expenditure, on the investment in their fields. They're looking out further. They're seeing that oil demand is going to come down in the future with renewables, with electric vehicles, with all these other alternatives, and so they're not investing quite as much in the kind of compression services, the kind of equipment and things that is provided by companies like U.S. Compression Partners. So revenue growth is probably going to be a little bit lower, but it's still very, very good cash flow company. 14.1% dividend yield is something you just can't ignore, and you got to look further into it. Let's go to the dividend growth history first here, and we'll go to 5 years, and we'll see that it is held really stable at $52 or 52 cents per share all the way back to 2017. So it does have that commitment to holding the dividend at that 52 cents per share. We can go to see how much of the income it's paying out. Now it says an NA for payout ratio. That probably means the income is negative. So we want to check that. We can scroll down here on the home page and see that it has been reporting negative earnings. Okay, so negative income. It actually missed earnings expectations last quarter, and for 3 of the last 4 quarters, it has missed earnings expectations. So I imagine that is weighing on the stock, that is holding the stock price down and really contributing to that dividend yield because the dividend hasn't moved, even though the stock price has come down a little bit. So it is negative earnings. We would want to check out to see, in that market, but even though companies are pulling back on their spending in their fields, this is still going to be a fairly strong growth growth in revenues for this company, I think, because they still need those compression services for those fields. So even if they're not trying to grow their production, a lot of these oil companies, they're still going to be paying for these compression services. So I don't think that this is quite as dire as maybe those earnings look. We can check out the balance sheet, which obviously any company that is having that earnings problem, that earnings weakness, you always want to check out the balance sheet to make sure they have the cash on hand to survive that near-term economic pain. Okay, so if we come down here to the balance sheet, it has $250,000 in cash. So a little low. It's only a $1.5 billion company. So $250,000 probably will hold it for quite a while. It is still positive operating cash flow and positive levered free cash flow. So it is still producing, $270 million in free cash flow every year. So not quite too worried about this $250,000 in cash on the balance sheet. I would like to see it have more cash reserves just to be a little bit more stable, a little bit more uncertain, or a little bit more certain there. But since it is a positive operating cash flow, positive free cash flow company, I'm not quite as worried about that. It does have $2 billion in debt, so I would like to see them pay down some of that as well. Quarterly revenue growth is weak, 1.9%. Like I said, a lot of these energy companies, they completely stopped, spending on these equipment services during the pandemic when oil prices fell off a cliff, and they haven't really gotten back to that level of spending just quite yet either. So we can look at the total revenue, and actually total revenue has done pretty well. Revenue was up from $280 million in 2017, boomed up to $700 million in 2019. It did fall off last year, as we saw with the pandemic, and has fallen still further a little bit to $630 million in the last 12 months. But still very strong 4-year revenue growth, since 2017. We can look at the average analyst target, and for a stock paying a 14% dividend yield, I wouldn't expect much upside price appreciation, but we still have a 1-year target estimate for $17 a share over the $15 share price. So that's going to be a 13% upside potential on the stock. So 13% upside potential along with that 14.1% dividend yield. We've still got 3 of the highest paying dividend stocks in our list, but I want to give you a little more on that, how to analyze these for your portfolio. Now, understand, we're just using the very basic dividend screener for this list, but basically just looking for the highest yield in each sector of the economy. Now, that doesn't necessarily make it the best stock to buy, though. Now, those of you in the nation know we do a lot of that fundamental analysis to pick the best stocks here on the channel, but for this, I want to make it really easy on you and get back to our list. So instead of digging into the payout ratio, the sales growth, and all the other things that you can do to look at these types of stocks, I just want to focus on 2 factors to narrow down your dividend stocks. First is to make sure the company has increased its dividend payment regularly in the past. For this, you can look here on Yahoo Finance and go to the historical data tab for the stock. Here you can change the time frame to 5 years and then change this to show dividends only. And looking over the dividend history, you'll be able to see how regularly the dividend has been increased and by how much. And next is another easy one, making sure the stock price hasn't fallen too much and wiped out your dividend returns. And for this, it's just a matter of looking at the price chart. Now granted, even some of the high-yielding stocks in this list haven't seen the price do that much, but ideally you don't want to be losing money on the stock while you hold the shares. A sector I think could do really well over the next year, financials, and the top dividend stock here is FSKKR Capital, ticker FSK, and it's 12% dividend yield. Now, FSK is a business development corporation, which means it kind of acts as a banker to a lot of small and mid-sized companies, companies that are too large to go to just their small local community bank or regional bank for money, but not quite large enough to tap the capital markets with a share issuance or something like that. So it acts as a banker and equity investor in a lot of these mid-sized companies. It pays out a great dividend yield. And really, we'll check the historical data, the dividend growth here, and usually these pay out very strong dividends and have a strong commitment to those dividends, which is always really important for dividend stocks. So you can see it did decrease the dividend just this last in December from 65 cents paid out in September to 62 cents paid out in December. That's a quarterly dividend. And what you'll find with a lot of these business development corporations is they pay out almost all their net income as a dividend. So each quarter, they pay out almost all of the income, the profits that they've made as that dividend. So that results in a very kind of a volatile dividend. Okay. One quarter might be excellent profits, very high net income, and they're going to pay out most of that as the dividend. The dividend yield shoots up. They have a very strong dividend payment. The next quarter, net income and earnings might not be quite as high, so they have to cut that dividend marginally. And you can see here that it has cut. So it cut from 89 cents in 2017 down to 76 cents. It's since cut it to 65 cents a share, but still 62 cents a share on a quarterly basis for this stock is still a strong 12% dividend yield. 1 year target estimate of $22 a share is about 10% over the current share price. So not only are you looking at a 12% dividend yield, but also a 10% upside on the shares. We can look at some of these other statistics here as far as the debt and the price to sales ratio of 2.4 times on a price to sales basis. Now for these financial companies, since they do operate a little bit differently, you can't really look at the debt and the cash on hand because it's accounted for differently than you're used to seeing on a lot of those other companies. But it did have negative operating cash flow over this last 12 months. So that is something that we would want to check out. One thing you always want to look at for these BDCs, these business development corporations, is the average weighted portfolio yield. Okay, that's going to be found in any of the financial statements from the company. That's the average yield, the average interest rate it's collecting on its portfolio of loans. It's debt that it's loaning to these mid-sized companies. You want to make sure that that is over this dividend yield. That is more than the dividend yield. So you would want to go to KKR Capital Corporation, the financial statements, look for that average weighted portfolio yield and make sure that's over 12%. Basically, you want that dividend yield to be less than the yield they're collecting on their loans, just as a sign of dividend stability. Another stock here I own, I have a big stake in, actually over $50,000 in this one, in the consumer staples, Altria Group, ticker MO, and it's 7.7% dividend yield. Obviously, Altria is a big name in the tobacco segment, very stable cash flowing business. So it obviously pays out a very stable dividend yield, and we can check on the historical payments on that. It is a very good stock for increasing that dividend and for consistency in payments. So we can check this out over the last 5 years. It has increased the dividend from just 61 cents a share. That is a quarterly dividend, goes out 4 times a year. Increased it from 61 cents a share all the way up to 90 cents a share. So great dividend growth story on that one. We can look at some of these other statistics. We can see the payout ratio. So how much is it paying? It says it's paying out 233% of income as a dividend. So we would want to check on that. That is a little high. Obviously, I don't think management would pay out 200% of net income as the dividend because it just isn't sustainable. And this is obviously a company that cares very much about sustaining its dividend, growing its dividend. We can see that it had $2.7 billion in net income over the last year, $2.7 billion in earnings. We can see that it's been pretty volatile. It's come down quite a bit over the last few years, as well as took a big hit there in 2019, just on a lot of those legal expenses. But $2.7 billion in net income, and we can go over here to see how much is paying out in dividends. If we go down here, financing cash flow, again in the income or in the cash flow statement. And we can see cash dividends paid of $6.3 billion. So it is paying $6.3 billion to cover those dividends against just $2.7 billion in net income, in earnings. So that is something that is unsustainable. It's something that's going to have to change. Obviously, the management thinks it believes that it's going to be able to turn that sales and earnings picture around to be able to sustain that dividend because Altria Group is, like we saw, is one of the best for increasing its dividends. If we look here at the 1 year target estimate, analysts have a $53.61 per share average target estimate over the next year. That is 46.88. That is 14% over the current stock price. So again, like most of these stocks, you're not going to get that huge growth in the price or the expected growth in the price, just 14% here. But that's on that 7.7% dividend yield that despite that payout ratio, despite the hard or the weak earnings environment that it's in right now, I think that dividend is safe. I think it keeps on growing into the future and you keep on getting that 7.7% dividend yield. A solid company here in the consumer discretionary sector, H&R Block, ticker HRB, pays a 4.6% dividend yield. And obviously this one is coming into its prime earnings season here with tax time coming up. We can look at see how well it's increased its dividend in the past, see what kind of dividend history it has. If we change this, we can see that it has increased its dividend. It has increased its dividend over the last 5 years from 22 cents a share. That is another quarterly dividend payment. So that goes out 4 times a year. It's increased it from 22 cents a share in 2017 to 27 cents a share in 2021. So it does have a history of increasing the dividend pretty much every single year. It didn't increase it quite as much here in 2019, 2020, trying to protect that cash flow during the pandemic, but it has since returned to increasing the dividend every year. So that's obviously a positive sign. We check this payout ratio. It's only paying out 33% of its net income, of its earnings, to cover that dividend. So that is obviously, that is the lowest payout ratio of any of the stocks in our list. Obviously means that H&R Block is keeping a lot of its earnings set aside for growth, reinvesting in the business. So you're actually going to see, you're either going to see a higher share price or more opportunities to increase that dividend. If it's only paying out 33%, so a third of its earnings as a dividend, it can increase that to 50 or 60% easily and still be able to grow the company. So I think you see larger dividend increases in the future on this one. If we look at the balance sheet, it does have $900 million in cash on the balance sheet against almost $2.5 billion in debt. This is a strong cash flow company, so I wouldn't be quite too worried about that. The operating margin, 25% here, operating margin on the company. So management is doing a great job of converting those sales into operating profits. And we can check here on their 1 year target estimate, only $25.80. Analysts have that average target price on the stock. That is just 10% above the current stock price. So analysts really don't think much of the upside potential on the stock, just 10% over the next year on top of that 4.6% dividend yield. But I think this is one analysts might be underestimating here. I think with that growth in its revenue, in its and the strong operating profits, the strong payout ratio, I think this one could go higher than just that 10%. Click on the video to the right for the cheapest stocks in each sector, 11 of the best value stocks in the market. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.